Are you having a hard time thinking when is the best time to save and invest your money? Well, this video is made for you. First, let's have an introduction to saving versus investing. To assure financial security and a bright future, it's crucial to understand the differences between investing and saving. Even though both phrases are occasionally used synonymously, it's significant to remember that they're extremely different. Beginning early is a fantastic approach to positioning oneself for long-term financial stability. Saving and investing are both essential components of personal finance. What is saving? Individuals set aside cash for both purchases and unexpected expenses. Saving, which involves putting money aside for future use, is a crucial aspect of personal finance. Imagine depositing your money in a piggy bank, but you can use a savings account or a certificate of deposit or CD that accrues interest as opposed to a real piggy bank. Savings can be used for a variety of things, including vacations, new technology purchases, and emergency funds for unforeseen costs. Saving is a great method to fulfill short-term financial objectives and plan for unforeseen expenses like car repairs or medical expenses. By consistently setting money aside, you can create a safety net that'll help you get through difficult times. Savings are typically low-risk investments, so your money is secure, but the interest you earn is also modest. Just a tip: in general, time frames of a year or less are regarded as short-term. Keep in mind when you'll need money, how you want to use it, and the goal's level of safety and risk. For example, one way to save is to allocate a percentage of your salary or allowance into a savings account each month. Let's imagine you have 10 months to save $1,000 for a new laptop. You can achieve your goal without paying interest on a loan or credit card by setting aside $100 each month. Automatic transfers are another way to ensure that you constantly save money without having to remember to do so. The pros and cons of saving. Saving has several advantages, including offering a safety net for unforeseen catastrophes, liquidity for short-term goals like purchases, and loss prevention. There are some disadvantages to take into account, such as the possibility of losing out on assets with larger potential profits. Periods of rising inflation can also lead to savings to lose some of their purchasing value. Saving is a key component of any financial plan, but for there to be a balanced approach to financial planning, it needs to be combined with other types of investing, such as retirement accounts or stock market investing. Here are the pros of saving. First, it increases one's emergency fund. Second, funds for pressing needs like a new phone, vacation, or the purchase of groceries. And third, little chance of loss. FDIC insurance covers savings kept in banks. Now here are the cons of saving. First, very low yields. Second, possible loss due to inflation. And lastly, when money isn't put into riskier but higher yielding assets, opportunity costs accumulate. Moving on to investing. What is investing? By putting your money to work in financial instruments like stocks, bonds, and mutual funds, investing is a method to see your money grow over time. Contrary to saving, investing entails some risk, but it also has the potential to generate greater returns over time. Long-term financial objectives like saving for retirement, a down payment for a home, or college can be attained by investing. Because investing entails some risk, it's critical to make investment decisions that are consistent with your objectives, level of risk tolerance, and time horizon. As you have more time to ride out the ups and downs of the stock market, you can generally take on more risk the longer you invest. Consider the scenario where you wish to invest in a business like Apple. You can own a small portion of the business and take advantage of its expansion and earnings by purchasing shares of its stock. If Apple succeeds, the stock's value may rise over time, enabling you to sell it for profit. One thing to keep in mind is that there are no certainties while investing, and there's always a chance of losing money. Your investment might be practically worthless. For instance, if Apple were to file for bankruptcy. To lower your risk, it's crucial to diversify your portfolio by making investments in various businesses and sectors. A good example of investing is using a 401k retirement plan, which is setting aside a percentage of your income to invest in a diverse portfolio of stocks, bonds, and other financial instruments to increase your savings over time. Several employers provide 401k plans as a sort of retirement account as a benefit to their staff members. You make a portion of your salary contribute to the plan, and your employer may match it up to a specific amount. The funds you make to the plan are subsequently invested by the plan administrator in a portfolio of mutual funds, equities, and bonds. Tax benefits are the main benefit of using a 401k retirement plan. You pay less in taxes because the amount you donate is subtracted from your taxable income. Furthermore, your 401k assets grow tax-deferred, allowing your money to grow tax-free over time and possibly generate higher returns than a conventional savings account. Before you begin taking withdrawals from the account, taxes aren't due. Putting money into a 401k plan emphasizes how critical it is to begin saving for retirement as soon as feasible. You can take advantage of compounding returns and potentially greatly increase your retirement funds by investing regularly over time. In order for your investments to continue to satisfy your needs, it's crucial to select a combination of investments that are compatible with your risk tolerance and retirement goals. You should also examine and modify your investments frequently over time. Just a tip: while having a large portion of your investment portfolio in cash can produce cash drag and reduce your portfolio's potential profits, financial experts do not advise doing so. The pros and cons of investing. Investing can help you reach long-term financial objectives like saving for retirement or purchasing a home by offering the possibility of larger returns than savings accounts, the capacity to expand your wealth over time through compounding and reinvestment, and more. There are, however, some drawbacks that must be taken into account. There's never a 100% assurance that you'll make money investing, and even if you do, there's no promise that you'll get your money back. Having a diverse portfolio of holdings might be beneficial. It's crucial to conduct your homework and comprehend any potential risks related to various investment forms. It can be challenging for some people to retain discipline and a long-term perspective when faced with market volatility or the desire to go with the flow to earn quick money. Pros of investing. First, the chance of greater returns than savings. Second, can aid in achieving long-term financial objectives. And third, diversity helps to lower risk. Cons of investing. First, loss possibility, especially in the short term. Second, requires commitment and discipline. And lastly, possibly calls for larger time horizons. The big question now is when to save and when to invest. Which is better for investing or saving money is one of the most frequently asked questions. Your unique financial status, ambitions, and level of risk tolerance will all factor into the response to this question. Even if your income and spending may be low while you're young, it's never too early to begin planning for savings and investments. In reality, getting started early might provide you with a big advantage in terms of long-term wealth accumulation. You can achieve long-term objectives like saving for retirement or college through investing. You can take greater risks and invest in riskier items since you have more time as a young person. Even if you experience short-term losses, you'll have more time to bounce back and reap the rewards of long-term investing. In other words, by making regular and early investments, you can benefit from the force of compounding, which allows your money to grow rapidly over time. Experts advise moving away from riskier investments like stocks and toward more conservative ones like bonds and cash as you get older and have a shorter time horizon. This is due to the fact that short-term volatility poses a greater danger if the market declines right before you want to retire. Saving is usually a good idea even for younger people if you have short-term objectives like saving for a new phone, laptop, or vacation. What's important is, make sure you have enough money set aside in an emergency fund to cover several months' worth of expenditures before investing any money, as well as enough in your savings account to cover all of your immediate requirements such as bills, rent, and groceries. What's really riskier, investing or saving? Saving has very minimal risk by definition. On the other hand, investing entails a risk of financial loss. As a result, investing generally entails greater risk than saving. Why do some people rather choose to save than invest? For a variety of reasons, some people may decide to save rather than invest. Some people enjoy the sense of security that comes with having more money saved up in case of crises or unforeseen costs. Others might have more immediate financial objectives, like saving for a trip or a down payment on a home, and would rather put their money in a low-risk savings account. Also, some people can lack the information or experience necessary to invest, or they might have a low risk tolerance, making them uncomfortable with the level of risk involved. Finally, after paying for their necessities, some folks may just not have any money left over to invest. How much money should be saved and invested? Depending on one's own financial objectives, risk tolerance, and situation, you should invest more money than you should save. A reasonable rule of thumb is to set aside money for 3 to 6 months worth of living expenses in an emergency fund, along with money for short-term responsibilities like bills, and then invest the remaining funds. So the precise balance between investments and savings will rely on a variety of variables, including age, income, debt load, and long-term financial objectives. A sound financial plan should include both savings and investments. While investing has the potential for higher long-term returns and can assist in reaching long-term financial goals, saving offers a safety net and a tool to accomplish short-term objectives. Losing money is a possibility while investing, though. Finding the proper balance that fits your financial circumstances and goals is crucial because each strategy has its own advantages and disadvantages. In the end, a well-rounded strategy that incorporates both saving and investing can aid in wealth creation, serve as a buffer against financial shocks, and provide the groundwork for a more stable financial future. So that's it. What do you think of the differences between saving and investing? Share your thoughts in the comments below. Don't forget to click that subscribe button, ring that notification bell, hit the like, and share this video with your money and business-minded friends. Until next time.